Welcome to Part 1 of Baird's 2026 Market Policy and Planning Outlook. In this segment, Nicholas Bohnsack of Strategas, a Baird company, will look ahead at the U.S. stock market and the economy in 2026. What is your outlook for the U.S. stock market and corporate profits in 2026?
As 2025 draws to a close, it appears that the U.S. economy is emerging from a protracted soft patch. This was very likely made worse by the more than 40-day shutdown of the U.S. government. But we take comfort in the fact that the U.S. consumer has emerged right on time. And as we approach the year-end holidays, we've seen strong results. Retail sales have been growing relatively well when compared to last year, 2024, and this sets us up for what should be a decent first quarter in 2026. As we look beyond that horizon, we're further encouraged by the potential for significant fiscal stimulus to hit the economy in and around the traditional late March and early April tax reporting season. Some of you will recall that last summer, the government passed a significant piece of tax legislation. Regardless of one's opinions about this president, the administration, or their policies, roughly $500 billion in tax refunds are slated to be returned to U.S. taxpayers in April. And most importantly, $150 billion of that is incremental to the level of tax refunds that U.S. taxpayers enjoyed last year in 2024 and the year prior in 2023. But not to be entirely reliant on fiscal stimulus, we also take some comfort in the broadening base of U.S. corporate profits. Profits throughout 2025 have remained consistently strong. In fact, the recently completed third quarter saw S&P sales growth nearly 8% and profits increase more than 13% year on year. But I'm even more encouraged when we look at the potential for S&P sales growth to grow next year, 6.5%. That's twice the rate of nominal GDP. And it's tough for the economy to get into trouble when corporate profits are following through on expectations. So when we look out to next year, we have an equally strong profit outlook. The consensus is looking for something rather robust at about 12 to 13% growth. Our estimates are just slightly less than that, at about 10% when taking into account some supply chain dislocation. But altogether, a strong backdrop appears to be forming to support the continued advance of U.S. shares.
Which indicators are you watching to gauge whether the market is in bubble territory?
An examination of bull markets that the United States has enjoyed since the end of the Second World War reveals that the current bull run ranks only 11th among the 14 by both order of magnitude and duration. So at a very superficial level, it might suggest that this bull run has got some ways to go. Not satisfied with that answer, however, we look under the hood and we're pleased to find that we continue to see a strong bid to cyclical shares, that is, stocks that would do well when the economy is expanding. And when we focus even further on the data, stock prices are generally a function of earnings and interest rates. And with the Fed in the second phase of an easing cycle, bringing interest rates lower, and U.S. corporate profits persistently strong, as we noted a moment ago, we're encouraged by the fact that valuations, while toppy, perhaps have a little more room to run for expansion. Moreover, the performance concentration that we've seen in the Magnificent Seven, those big tech hyperscalers that are leveraged to artificial intelligence trade, have started to broaden out, notably in the past month since the end of the U.S. government shutdown. So in the important process of portfolio construction, we remain bullish on the resiliency presented by a diversified allocation across styles and sectors, backstopped by companies with very strong free cash flow.
What should investors know about investing in midterm election years?
Investing around the U.S. presidential cycle offers one of the most interesting performance profiles of any of the historical analogs we have available to us. On balance, the stock market tends to do very well in the first year of a president's term, and this has been true whether the president is new to office, has been reelected, or perhaps, like Donald J. Trump, is enjoying a second first year, although not contiguous to his first term. In the second year, however, the stock market has tended to recede modestly and ultimately finish the year flat as both parties, Republican and Democrat alike, particularly in more recent cycles, gear up for a contentious midterm election cycle, before breathing life again in the third year as both parties grease the skids for the forthcoming presidential campaign and want a strong economy behind them. However, given the degree of fiscal stimulus on offer from last summer's tax package and the Federal Reserve currently in an easing cycle, one wonders whether the second and third year of this term may indeed be reversed relative to that historical precedent. Said another way, can 2026 be stronger on the back of a U.S. consumption wave before a slightly weaker environment presents in 2027? Stay tuned.
What economic theme do you think is being under-discussed heading into 2026?
As the U.S. economy emerges from a fourth quarter soft patch, conversations with clients reveal that one of the most underappreciated themes as we look out into next year is the very real potential for a 2026 consumption wave. Indeed, consumer data has recently perked up as we head into the year-end holidays, and the Fed, by extension of its easing cycle, seems intent on not allowing the labor market to falter. Perhaps most importantly, fiscal legislation that was passed last summer is slated to provide the U.S. taxpayer with as much as $500 billion, just slightly more than $500 billion of refunds during the April filing period. $150 billion of that, as we mentioned, is incremental to the level of refunds we saw last year in 2024. Now, for their part, U.S. corporations aren't left out. There's $250 billion in the package for additional spending through tax credits. $100 billion will hit in 2025, and an incremental $150 billion next year in 2026. On top of all of it, the United States, along with its neighbors to the north and south, Canada and Mexico, as you know, will be co-hosting the FIFA World Cup next summer, which will invite no shortage of infrastructure spending in the months leading up to the event, and a fair amount of travel and leisure spending during the matches themselves. And last but not least, the United States will celebrate the 250th anniversary, the sesquicentennial, of the signing of the Declaration of Independence. Altogether, a seemingly healthy backdrop for an expanding economy and a continually strong stock market.
Thank you for tuning in to Part 1 of Baird's 2026 Market Policy and Planning Outlook. We'll be back in January to share Part 2 for planning opportunities to explore with your Baird Financial Advisor team.